Welcome to ZIA TV, covering small cap stocks and emerging companies. Today we have the pleasure to speak with Len Batterson, CEO of V Capital, about his upcoming book, Building Wealth Through Venture Capital, a practical guide for investors and entrepreneurs that they fund. And Len is a co-author. His name is Ken Freeman. Len, welcome to the program.
Thank you.
Thank you
Appreciate
for being
that very
here with
much.
us. Tell us a little bit about your basic approach to venture capital, would you?
Well, we work out of Chicago. About half of the investments we make in venture capital are Chicago-based, which is kind of unusual for a venture capital firm. The other half are pretty much all over the country. We like to invest in what we call early stage venture capital. So that's sometimes called seed or startup or early stage. And so that means that generally the company is just beginning. Sometimes it's just an idea. And sometimes we actually have the idea ourselves because we're kind of entrepreneurs as well as investors. So if an idea comes along that we like, then we'll do the homework and put it together and start the company. So that's a little different from most venture capital firms who have a tendency to just invest capital. So they don't normally act as entrepreneurs as well. So that's a bit of a difference. And we also invest in what we call hard science, hard technology, and hard medical investments. So these are investments that the technology is usually fairly complex. And we have to do a lot of what we call due diligence or homework on these investments. Some of them we have spent over a year doing the homework before we made the investment. Probably more common is we'll spend about 6 months actually doing the homework. And you hope to exit these investments with cash, at somewhere generally between 5 and 10 years. And sometimes it's a little sooner, sometimes unfortunately it's a little longer. And generally you're trying to make about 10x on your money on the investment that you make, and or a pretty significant internal rate of return, which you would hope for better than 20% or even better than 30%, or sometimes even better than that. So over a period of time, I've been doing this about almost 40 years now, and we've had about a 28% average internal rate of return every year for almost 40 years. So we like to say, well, we beat Warren Buffett by a little bit. Although he's got more money than we do.
Over that period of time, what are some of the ways that you've seen venture capital change?
Well, I think probably the major change when I first got into the business, you could invest in a company, you could build it up, and there were a number of smaller to medium-sized investment banks that would take the company public in an initial public offering. They used to be called the Four Horsemen, so it was Montgomery Securities and Rothschild and Alex Brown and LF Rothschild. So you could get the company up to maybe 20, 30 million in revenue, probably not profitable yet. And these smaller investment banks would take you public, but most of them are gone now. Basically moved on to other things, or were merged or sold or out of business. So now you really can't do that. So that means that your exit for cash is to sell the business to somebody else. But the lack of that kind of IPO market sort of puts a cap on what you can sell the company to somebody else. Because when you had the IPO market, you kind of had like another bidder, which was the IPO market.
Sure.
That really doesn't exist anymore. So most venture capitalists are having to swing for the fences and hit home runs now. So these kind of smaller deals that you could exit for nice money, it's pretty much gone. So we got to go for the big ones now.
What about difference between West Coast and Midwest venture capital? Is there a difference?
Sure. First of all, there are a lot more venture capitalists on the West Coast, and they have a lot more money than we do here in the Midwest, in total. But I think there are a couple of other differences. One of the things on the West Coast is that, if you start a company, generally you've done it before, for one thing, which may or may not be true here. But also, you know a lot of folks out there that you've probably worked with before who are running other companies. And so you start yours, you call up your friends, and you can sell them stuff. So you can ramp the company up much faster because your friends will maybe buy 10 million of what you've got, and pretty soon you have a $50 million revenue company, which is well on its way. Here, I think in the Midwest, we really have to work hard to sell stuff. So it takes a little longer. It's more of an effort, probably a little more focus here. The other thing I think about the Midwest versus, say, Silicon Valley or the West Coast is we really try to build what I would call real businesses. I think sometimes in California it's a little Hollywoodish. And,
are you saying that they like to build facade towns out there, Len?
Well, that's a good description. Some of these things you kind of wonder whether these things are going to be around very long. You know, and occasionally they are, and occasionally they become huge home runs, you know, as we all know, like Facebook and other things. But also there's a lot of sort of Tinseltown stuff that sort of vanishes. And I think Midwest investors really like to do real things that have substance and will last a long time. We were fortunate enough to be in an investment recently we exited called CleverSafe, which was started here. It was sold to IBM for north of $1 billion. A very real business in cyber storage and security, which will last a long time, and IBM will take probably into the billions of dollars, you know, for their account.
Sure.
So those are the kind of things that we like to do. Or we made this recent investment to try to help beat back cancer, and we're in human trials now with that, and it's going very well. If it's successful, we're going to kill a lot of cancer. So that's what I would call a real deal.
Sure.
That can also make a difference. Our job is not particularly to do good. We generally have to focus first on doing well and making money for our investors. Otherwise, we don't get to be in this business for much longer. But occasionally we can do something where we can do some good. And the cancer deal would be an example. The company is called Intensity Therapeutics. Again, in human trials now. And if it works, a lot of cancer is going to get cured.
Fingers crossed on that one.
Absolutely.
Let's talk a little bit about the investor. How has the investor base changed for venture capital?
Well, I would say that one great change is that a lot of individuals are now investing in venture capital. So when I first got into the business almost 40 years ago, most of the venture capital funds came from institutional investors. So these were pension funds or insurance companies or corporations. I started in the business at the Allstate Insurance Company, which was a major venture capital investor. So not a lot of capital came from individuals. Some, but not much. Today, you know, it's estimated that over 480,000 what we call accredited investors, people that meet certain income or net worth tests, invest in venture capital every year. That's a lot of people. Also, recently the Jobs Act was enacted and implemented by the SEC. So now more and more accredited investors are able to invest in venture capital. You're able now, like we have done with our firm V Capital, to take venture capital online, and investors can now go online and invest in venture capital. Also, most recently under the Jobs Act, you don't even have to be an accredited investor to invest in venture capital. Mom and pop and grandma can now invest. The SEC put some pretty tough restrictions, so generally you can invest about maybe 1% of your income each year if you're not an accredited investor. If you're an accredited investor, though, you can invest a considerable amount of capital. Our firm only works with accredited investors.
Meaning?
Well, it's someone who generally You have to have an income level of several $100,000 a year for a couple of years, and then the next year it has to look like you're going to do the same. Or you have to have a net worth of approximately $1 million, not including your house value.
I'll call you after the show.
So you have to be pretty well off to qualify, and the SEC put those rules in place because venture capital is a risky business. We have been fortunate enough to do well and make a lot of money for ourselves and for our investors, but many of the investments we make are not successful. So in the industry as a whole, only about 15% of all venture capital investments actually make any money at all. Maybe 1 out of 12 is what we call a home run, so kind of 10 times your money,
sure,
or better. So it's a tough business. Now, our firm, we've been lucky and fortunate, and I hope smart. Our percentage is not 15, it's 38%. So we've done pretty well. Sure. We've had 4 companies that became ultimately multi-billion-dollar market capitalization companies. America Online, which was a few years ago, and several others, and then most recently CleverSafe, which we sold to IBM, as I mentioned, for $1.3 billion.
Respectable numbers.
So we've had some luck.
Let's talk a little bit about the biotech sector. It's kind of hot. What are you finding in that hot sector?
Well, interestingly, in Chicago, we're seeing a large number of biotech or biomedical, or what they now call life science investments. There are a lot of them here in Chicago. Silicon Valley is better known, obviously, for software, for computer-related investments. But the Midwest, there's a very large deal flow of medical or biomedical or biotech-related investments. So, besides the one I mentioned, the potential cancer cure, we're working on several others. One is, when people think they might have a heart issue, often the doc will say, go get a stress test.
Sure.
However, stress tests are not always all that accurate. So it doesn't always tell you whether you're about to have a heart attack or whether you're about to have a problem of some kind with your heart. There's a new device that's been developed that looks like a small MRI machine. And they use electromagnetic radiation, and they basically stick you in that thing like an MRI. And it can predict the condition of your heart and whether you're likely to experience a heart attack.
Wow.
So again, it's got to work, and it needs some capital. But that's one we're looking at that I think is pretty exciting, because there'll be a lot fewer heart attacks and a lot fewer people dying if this works.
So as far as the entrepreneur is concerned, what type of entrepreneur really excites you?
Well, I think it's mostly about passion. It does help if they have done this before or have some experience. Often we really don't mind if they've failed before. Sometimes failing 2 or 3 times is not a bad idea. We'll look at why they failed and why the prior ideas didn't work or companies didn't work. But somebody that really is into kind of what they're doing. One fellow we invested in recently, very interesting answer. So one of his very close friends is the entrepreneur who started CleverSafe, which I've mentioned. The 2 of these guys go out to the Grand Canyon and run up and down the side of the hills in the Grand Canyon. So, and when they're not doing that, they're out in the woods running these ultra marathons in the woods together. And so I asked Jeremy, the fellow's name, I said, well, what do you want to do with this? And he said, well, I want to beat the tar out of my friend who sold his business for $1.3 billion. So that's passion.
Sure.
He's really into it and really committed. That's mostly what we're looking for. In our business, it's not so much, honestly, the industry or the product or the technology. I mean, we look hard at all of that, but it's really the person. Are they committed? Are they people that persevere, don't give up, stay in the fight, keep at it, never stop. That's what we have to have.
Why did you write this book?
Well, probably a number of reasons. My co-author Ken Freeman and I were in business school together more years ago than I would care to tell you. But we were classmates in business school, and we went to class together every day and sat in 5 or 6 classes. You know, we kind of started out learning together. And I think of the venture capital business really as a continuous learning process. Every time an entrepreneur comes in, they come in with something exciting and new, and we get to learn, you know. Eventually, if we work with that person, we get to coach. So we're kind of teachers as well, coaches. And to be able to sort of take 40 years of experience and put it into a coaching book, which we view this as, you know, will help entrepreneurs, will help the business. Some entrepreneurs will learn more about us and come see us, you know, which is another purpose. So it's not totally altruistic, you know. Yeah. Also, we want to explain to potential investors exactly how this works, you know, what all the numbers are and how you can make money doing this, how you can lose money doing this, you know. So all the kind of tricks of the trade that we've learned over a long period of time are in this book, both for entrepreneurs and for investors.
So any danger there, revealing the tricks of the trade? I mean, like the magician who doesn't want to tell you how a secret is to do the trick?
Perhaps, but I think over the years there's so many good opportunities that we have a chance to look at that I've never felt that, I really never felt like I had real competitors, because so many good things just come along, you know, and we tend to look sometimes pretty far into the future, kind of as far as the eye can see. So that also tends to eliminate a lot of the competition, because maybe they're not always looking out quite as far. Or another way to put it is maybe they don't want to take quite the risks we sometimes take. We've always been very interested in what now is called, the popular word is disruptive technologies. So again, over the years, many of the things we've done were highly disruptive. And a lot of times your competitors are just not going to reach that far.
Well, we thank you for being here.
Yeah, it's been great. I
certainly
really enjoyed
sounds like an interesting book. I'm going to run out to get my copy here as soon as we're done.
Well, we hope we get some readers. That's the main thing here now.
Thanks for being here,
Yeah,
Len.
thanks again. Appreciate it.
Don't forget, you can look for Building Wealth Through Venture Capital, a practical guide for investors and the entrepreneurs they fund, authored by Len Batterson and his co-author Ken Freeman. You can pre-order it now on Amazon.